All right, we are back together again. So, we're looking at chapter 10 right now. Chapter 10 is our discussion about financial markets and savings and investments. We just barely started this chapter the other day. So we're going to look at that today, but we also have a video. It's a fairly long video, but it's an extremely useful one to help tie together what we're discussing here. So we'll get to that later on sometime today. We'll start to look at it. But right now, let's just get back to the notes, and then we will take it from there. So hold on one second. There we go. Okay. I just have to find the link. That's all. Oh yeah, there it is. It's a fairly, like I said, it's fairly long, but it's worth watching. But in the meantime, let's just get back and remind ourselves what exactly were we doing in this chapter. Well, first of all, we started out by looking at the different types of capital that are out in the marketplace. So when we hear the word capital, we have to make sure we know what type we're referring to. So there's two basic types of capital. In a financial statements analysis class or something along those lines, you often talk about physical capital because this is what corporations use to produce goods and services. Financial capital represents the funds that we use to carry out our business operations. So here you can see that physical capital refers to machinery, equipment, buildings, whatever is being used to produce consumer goods and services by a business enterprise. It is referred to as physical capital. Okay, so like I often use Starbucks as an example, but when you walk into a Starbucks, they have a lot of machinery in there to make the drinks. Okay, so the blenders that are used to make the smoothies would be considered an example of physical capital. But financial capital is the funding that's used to run the business. Now, corporations, or any business for that matter, usually does not have a lot of funds on hand. They often will instead raise funds as they're needed by, in many cases, issuing stocks and bonds or possibly going to a bank. So if that same Starbucks that you're visiting has borrowed $100 million by issuing new shares of stock, that money would be considered to be financial capital. And they probably raised the money because they wanted to, let's say, build another Starbucks or maybe upgrade the equipment at all the Starbucks in the United States, or possibly create new products. You know, obviously businesses do require new products from time to time. And Starbucks is no exception. They're constantly tinkering around with new drinks that you'll see here and there. And the ones that are successful, they keep them. And the ones that are not successful, they get rid of them and try something different. But in order to avoid stagnating, most businesses do periodically introduce new products. Like you'll notice, for example, the Coke and Pepsi, they are frequently coming up with ideas for new flavors that they hope people will like. New variations of Coca-Cola, new variations of Pepsi-Cola, and they come and go. And they also have their basic styles. They have the Pepsi with no calories in it. You know, they have this and they have that. In fact, you know, it's interesting in foreign countries. I've been to England a few times, and I noticed that over there, Coca-Cola has this sort of intermediate product. It's sort of halfway between regular Coke and Diet Coke. It's a Coke that just simply has less sugar than what you're used to getting. I'm not quite sure how or why that happened, but it seems to be pretty popular over there, but I've never actually seen it here. I think here Americans prefer either to be the full version or else the diet version, and nothing in between will satisfy anyone. But in order to bring that product to market, Coca-Cola probably spent a very large amount of money developing it, and that money had to come from somewhere, and that somewhere most likely came from the sale of stocks or possibly bonds, because it was a very long-term project. Not something, you know, like a bank loan usually is reserved for very simple situations, like let's say the company needs to pay taxes on one of their buildings or something, and they need a lot of money in a hurry. They might go to a bank because the amount involved isn't that large and because they can repay it fairly quickly. But for longer term investments, like developing new flavors, that is the kind of thing that is probably financed with stocks or bonds because the money doesn't have to be repaid anytime soon. All right, now investment we also define as simply any activity that is designed to increase the amount of physical capital that a firm has access to. So when Starbucks buys more blenders, we define that as investment. Now, we often hear the word investment used to describe what people do with their savings, like as if an individual buys stocks, that is often referred to as an investment as well. It's just a different kind of investment. Okay, but they're both types of investment. But from the perspective of a business, investment usually means, although not always, it means they're requiring more capital to run the business. Sometimes corporations do invest in stocks and bonds, but it's a very small percentage of the total. Normally, investment there is simply, are we acquiring more capital to run our business or not? And if so, we call that investment. We also introduced the concept of depreciation, which refers to the wear and tear on our equipment, like those Starbucks blenders. They're using them all day long. So let's say as an individual, you own a blender, it probably will last for many years because it's, it's a very solid piece of equipment, but you're not making 100 smoothies a day either. So in a Starbucks, they probably have to replace their equipment pretty regularly. And so the value that's lost when using these machines on a constant basis like that is referred to as depreciation. Also, if you own a car, you know perfectly well how this works. If you bought a car even 2 or 3 years ago, certainly your car is not worth as much as it was when you first paid for it or bought it, because in the meantime, you put a lot of miles on it and it has now lost some of its original value. So this is depreciation. A lot of investment is undertaken simply to offset the depreciation that has taken place. Okay, that's important. A lot of investments are only done because our equipment is wearing out and we have to replace it. So if you look at the amount of money that's being spent to buy capital equipment, we often call that gross investment. But if you subtract now the amount of depreciation that we've suffered, the difference between total or gross investment and depreciation is often referred to as net investment. In fact, let me just throw a quick example in there, just so you get the idea. So suppose that a Starbucks, let's think of a single star, a small star, just one. Suppose that a Starbucks invests, and this is just a single store, so it's not a huge amount, invests $10,000 in new equipment. 1,000 of this is spent to replace a worn out blender. This means that the gross investment is $10,000, but the net investment, because we lost all that depreciation, the net investment is only $9,000. In other words, the value of our equipment is $9,000 higher than it was before this happened. So the net is only $9,000 because 1,000 of that is being used to replace equipment that had been worn out from constant usage. All right, now we also have to make an important distinction. This is true in all of economics. It's easy to get confused about the distinction between wealth and income. The way to think about this is that wealth represents how much we have or we own at one point in time. Okay, so if right now you look in your bank account and you see that you have, let's say, suppose an individual has $10,000 in the bank. Okay, this would be considered part of his or her wealth. Now, the income, though, is how much you earn per year. If the same individual earns $100,000 per year, this is the individual's income. Now, some of that money might end up being put in the bank and becomes part of his or her wealth. But right now, at this point in time, we would say that this person has $10,000 worth of wealth in the bank, and they also earn on top of that another $100,000 a year. That's what we call a flow variable in economics, meaning it's so much per year. So the distinction between the two is that wealth is considered to be a stock variable, which means that it is the amount held at a specific point in time. Income is a flow variable, it's called, because it is measured in units as so much, as a fixed or a given amount of money, number of dollars per unit of time. Okay, in other words, it could be your monthly salary, it could be your annual salary, whatever the case may be. Income is a flow. It's so much per unit of time. Wealth is a stock. How much do we have right now at this point in time? Okay. All right. So that's something we have to be careful about, wealth versus income. Now, capital gains and losses, this is something that occurs when you own financial assets, especially stocks. It's easy, many people own stocks. In fact, you only have to be 18 to buy stocks. And in fact, I've been informed by people who know what they're talking about that if you're under 18, as long as you have your parents' written permission, you can actually start buying stocks even younger than 18. There's a lot of these online brokerage accounts that'll actually accept accounts for people who are under 18, but they need their parents' written permission. And the idea here is that if you buy stocks, or especially stocks, their price goes up and down. Okay, that's just the way it works in the marketplace. The stock goes up, it goes down, it goes up, it goes down. When the stock price goes up, you earn what's called a capital gain. And when the stock goes down, you suffer what's called a capital loss. So if you're interested in studying more about stocks, one good place you can look for information is this website, which I'll show you now, called finance.yahoo.com. This is part of Yahoo, of course. And what's on here is all kinds of information about stocks. And so let's say I wanted to take a look at the past 5 years history of Apple stock. Now, in order to do this, you need to submit to the website what's called a ticker symbol, which I'll explain in a second. Let's take a little, by the way, here, if you look at the top of this page, you'll see that Apple is trading on the NASDAQ. What is the NASDAQ? Okay, the NASDAQ is a stock market where, and traditionally, mostly high-tech companies were traded. Okay, the NASDAQ, let's see, where can we find a good discussion about what this is all about? The NASDAQ is an electronic trading system. Actually, let's go to Investopedia. They should have a good definition of it. All right. The NASDAQ is a global electronic marketplace for buying and selling securities. It was invented in the early 70s when people in general didn't have computers in their own homes. So that, in other words, the trading is computerized as opposed to people standing on the trading floor yelling at each other, which is what you would see in the New York Stock Exchange. And so this was like a technological breakthrough where suddenly it became possible to trade stocks through computers rather than through human beings. And so it grew very, very quickly. And it became a national exchange in 2006. Then it looks like they merged with the Scandinavian exchange OMX. And yes, it was invented as an alternative to the inefficient specialist system, which had been the prevalent model for almost a century. This is now this is the most important in the sense that it is the most up-to-date, the most technologically sophisticated. This is becoming the most important stock exchange in the world. And wow. But anyway, So the Apple trades on the NASDAQ. And of course, they would have been listed there in the first place because it is a high tech company. And when you come right down to it, now you probably have all heard of the Dow Jones Industrial, or well, actually, I should think about this as the New York Stock Exchange is in Manhattan. You may have seen it down there in the Wall Street area. And this is the oldest, maybe the oldest stock exchange in the country. I think it might be. Let's check that out. This one has a very long and interesting history, but this is where traditional trading took place, where literally people would stand on the floor and yell at each other. So the New York Stock Exchange is located in Manhattan. Let's see. It dates back to 1792. How do you like that? 1792. That's pretty impressive. And now, in small stages, it's becoming less and less relevant because all the trading is moving to the electronic exchanges, and less trading is taking place between actual people. And in fact, the New York Stock Exchange may cease to exist at some point in the future. I've been told again by somebody who knew what they were talking about that the volume of trading is probably maybe 20% of what it used to be, just because this is no longer a popular form of trading. But anyway, so the NASDAQ has traditionally held all the, oh, he did. How cool is that? Wow. Now, did he tell you that he was glad to get out of that business? Did he get tired of yelling at other people all day?
Yeah, he actually loved it. He thought it was like really kind of engaging and exciting, but
Wow.
very long day. He had to get there very
Yes.
early, and it
Oh,
was long hours. Yeah.
sure, he was worn out. He's probably happier doing something else by now. It's only for the young, let's put it that way. And it was, yes, very stressful. I'm sure it was terribly stressful. So, but yeah, so he had a nice experience down there. But I'm sure that by now, you go down there now, you're not really allowed to visit the New York Stock Exchange for security reasons. But apparently, the volume of trading is much, much lower than it used to be. It's all being taken over by computer trading, and that's been the trend. So, but a lot of the big stocks are still trading on the New York Stock Exchange, but Apple is listed on NASDAQ. In the early days, NASDAQ was really meant for the high tech companies and the ones that were smaller. But now it's like becoming the biggest stock exchange in the world. But if we just want to look at the price of Apple for the last, let's say, 5 years, well, you kind of get the idea. 5 years ago, a share would have cost you about $25, and now it's worth over $125. So it's gone up by a multiple of 6 in only 5 years. Wow, that's a nice little rate of return. In fact, I'm going to figure out right now what that works out to on an annual basis. Wow, that's about 43% per year. If you bought this stock, your rate of return would have been approximately 43% a year. That's not bad considering that you're getting 0.5% in your bank account. So this is a classic example, and this is an extreme case, but so you can see that if you bought the stock, you'd be earning a lot of capital gains, although here there's a little downturn where you might have suffered capital losses. But for the most part, Apple is just going up and up and up. And why is that? Well, have you ever met anybody who does not own an Apple product of some kind, an iPad or an iPhone or a MacBook Pro? It's hard to find. Or, when things were more normal, if you walked into any mall, what did you notice about the Apple store? It's crowded. You actually do not own any Apple products? Wow.
Yes.
Well, they will figure out a way to sell you something sooner or later. You wait and see. They'll come up with something that you must have. The rest of us are addicted to Apple products. And in fact, they found a clever way to make sure we update them every couple of years. They know what they're doing. They know how to take money out of your pocket, but they're giving you something of value. So, it's fine. Now, there's a lot of useful information over here that you might use to help you make decisions about how the stock is doing. Now, a lot of these don't mean anything to you right now, but Here's a number that might catch your eye. If you took all the shares of Apple stock, however many there are, multiply them by their price, the total value of Apple stock trading in the marketplace is just over $2 trillion. That's a lot of money for a single company. The stock of that company is worth over $2 trillion. In fact, if they wanted to, they could probably buy Rhode Island for some reason they wanted to. Maybe not, all right, but still, it's a big, expensive, important company. And so it trades the NASDAQ, and the owners of the stock are hoping for capital gains. They want the price to go up. This is how you make money with the stocks. You buy stocks where you believe that the company is doing something that is bound to be successful. And so you buy it and hope that this actually happens. And there's a few other companies that have had this kind of spectacular growth, like, for example, Amazon. Look at our friend Amazon. Now its tickers, oh yes, the symbol on which it trades on the NASDAQ, it's also on the NASDAQ, by the way. The symbol is AMZN. That's how you uniquely identify a stock. And let's see how it's done in the last 5 years. Ooh, from 722 to 32 something. It's gone up by a factor of maybe 4 or plus over the last 5 years. And their market cap is worth about 1.7 or 1.6 trillion dollars. So just like my question about Apple, have you ever met anybody who's never bought anything on Amazon.com? Does that person exist? What do you think?
This is only half an eighth, so I think I'm gonna just roll it with the glass to preserve it, because I can't cop until.
Okay, well, anyway, so nobody's volunteered the name of a person who has never bought anything on Amazon. There may not be anybody at this point in time. I mean, they're so successful, but and that's why that happens. So if you now, of course, that's a lot of money to buy for a share of stock, but still, you know that it's only going to go in one direction, and that's up. Well, at least that seems to be the way it's going. You know, you can never tell. You don't know. But anyway, so capital losses occur when the value of an asset declines, thereby reducing your wealth. So obviously, when you invest in stocks, you're hoping for capital gains. Okay, now the markets for financial capital, we've discussed this as well, primarily consist of the bond markets, the stock markets, and then finally the market for loans. So the loan markets are where you can borrow money from banks typically to pay for short-term expenses. Of course, individuals borrow from banks to buy expensive items like houses and cars and furniture and appliances. And then, of course, we introduced the bond markets. Did I show you that picture of the coupon bonds? I think that was the Liberty bond. Yeah, so that's why these the interest payments on bonds are referred to as coupons. So a bond is characterized by the face value that you pay for it when it's first issued, the coupon rate, it's the percentage that you earn every year. The coupon is the dollar amount that you're entitled to receive, often either once or twice a year, depending on the country that you're in, usually twice a year in the United States. The maturity is how long will it take before they repay your principal. In the United States, most corporate bonds have maturities of 30 years, but sometimes it can be a little less than that. But we also saw that the Treasury Department issues bonds that can go down to as low as 1 month. Why do they do that? It's convenience. The more convenient it is for you to buy Treasury securities, the more likely you are to buy them, and the more money you're going to be willing to lend to the Treasury Department. Okay. Now, we did discuss this, I believe, that corporations are typically issuing bonds to borrow money to pay for things that they need to run the business. Governments issue bonds just to cover their deficits. That's the only reason they do that. They owe money. They rarely take in enough tax money to cover all their spending. So how do they cover the losses? They borrow it from the public through issuing Treasury securities. Now, here's another thing. I don't think we talked about this. Here's an interesting little provision that most corporate bonds have attached to them. The issuers often reserve the right to buy your bond back in the future before the maturity date. So what would be the motivation for doing that? Why would they reserve the right to buy it back from you early? I mean, wasn't the point of issuing the bond to borrow your money for 30 years? Why would they think about giving it back to you in 20 years?
They're willing to pay a premium in order to refinance at a lower rate.
Exactly. They're saying, listen, rates are dropping. Why should we keep paying such high interest rates if we can have the ability to repurchase these bonds, and then we can issue new ones with a lower coupon rate? And this is what they do to protect themselves from falling interest rates. So most corporate bonds are callable. So you have to be aware of that when you buy it. Okay, you got to be aware of the fact that if rates drop off dramatically, you might find yourself having to sell your bond back to the issuer. But this is the risk you take when you buy a corporate bond. But then they also may have this other provision built into them called a put provision, where the shoe is on the other foot. You have the right to sell it back to that maturity date. And that would happen when rates go up, because you want to replace the existing bond with one with a higher interest rate. So some bonds have put provisions, some have call provisions. Believe it or not, some have both. In fact, just as a side note, I just want to mention here that when you buy a bond, let me just throw this in here too. This is kind of important. The issuer, when an investor buys a bond, he or she is actually entering into a contract with the issuer known as an indenture. And the indenture specifies all the details about the bond, such as the maturity date, the coupon rate, any special features, such as call provisions, etc. So it's all written down somewhere. It's in the contract that you actually are entering into with the issuer, and they have to tell you all of this stuff. They're legally required to tell you what you're getting yourself into when you buy this bond. Imagine how chaotic it would be if they didn't have to tell you all of these details and leave you guessing. Now, we did actually start to look at the FINRA website, I believe, last time. Let's just go back and quickly revisit it. I just want to quickly look at a few cases, and let's look at some of the details that are listed. Let's try Apple, because we love Apple. What's going on here? Here we go. Market activity, no, search. Here we go. Apple. I hope it knows what that means. No, yes. Oh no, you know what happened? Because I used the ticker symbol instead of the name. Oh, I guess here we want the name. All right, let's try that again. Oh, you know what? I guess you could put, if I put it over here, that will do the job. Oh man, it's not happy with me. There we go. So you'll notice, for example, they're telling you all these different details about the bond. And if you want to click this on, it'll give you even more details, like the coupon rate, 2.4%, the maturity date, the symbol. These are symbols that uniquely identify the bond in the marketplace. Now here it is, callable. So this bond, when it was issued, it does contain a call provision, which means if they chose to do so, they could have called it back from the owner, but they apparently did not, because it's still trading in the marketplace. This is the most recent price. This actually represents 104.45% of the face value. The bond isn't actually selling for $104.45. That means 104.45% of the face value. So if it's a $1,000 bond, that means the price would actually be $1,044.50. Now, the yield can be thought of as approximately the rate of return to the owner of the bond, although it's a very complicated topic that we won't have time to get into right here. But roughly, this means that if you buy this bond, you're going to earn about 0.25% per year, which isn't much, but this is a very safe bond, and you're not likely to lose your money, and it's still better than what you could get in a bank account. Okay, so let's see what else might we need to know here. The bond, originally this bond was part of a series worth $5.5 million. All of the bonds are still outstanding. None of them were called in. Okay, it makes semi-annual coupon payments, as we would have guessed. The day count, 3360, means when they calculate your interest payments, they're treating each month as if it had 30 days and each year as if it had 360 days, which just makes things so much nicer. I think you'll all agree, it would have been nice if we had exactly a 360-day year. Just think how evenly things would have worked out. If only we could have had a 360-day year. Oh, wouldn't that have been nice? You never know, though. One day, scientists might figure a way to nudge the sun into a different spot so that we can have exactly 360 days per year. Yeah, in about 2,000 years, they'll figure that out. All right, and then we have our credit ratings, which I don't know if we discussed this yet or not, but we will. These are credit ratings by the two leading rating agencies, Standard & Poor's and Moody's, which are meant to tell us how safe this bond is. How likely is it that they will make the payments that they've actually promised you? Now, by the way, just as a fun side note, because we've got a few minutes here, talking about having a nice, even, round number of days and days in the month and the year. Did you know that during the French Revolution, the French decided to redesign the entire calendar and time itself so that everything was in units of 10? So we're going to go find a French Revolutionary calendar, and you'll see what I mean. Here we go. Let me find, where is it? Come on. So it had 10 days, 10 months. And if you look at them all very carefully, these were the names that they chose for the 10 months. And then you'll notice that one of them is called Thermidor, which you may have had a dish in a fancy restaurant called Lobster Thermidor. It does exist. And then the weeks were turned into 10 days. And let's just say, and then the clocks were converted to have everything in tenths. Anyway, but yes, so they tried, and it didn't work. It didn't last very long. But they had these strange ideas. And look at this: every day of the year is associated with a different fruit or vegetable or flower. That I didn't know. Oh my God. Well, anyway, so those were strange times, but they didn't last very long. By the time Napoleon was gone, they were back on the normal calendar. Okay, but anyway, so let's get back to this. So who issues bonds in the United States? The U.S. Treasury Department issues a lot of bonds to cover their deficits. They're massive deficits. Corporations, U.S. corporations issue a lot of bonds. Municipalities, which are city, state, and local governments. And then finally, we often see foreign bonds in the United States issued by either foreign governments or foreign corporations. And the nice thing about treasury bonds is that they're perfectly safe. There's essentially no possibility that they will fail to make the interest payments to you that you were promised. That type of situation is called a default. In other words, if the issuer of a bond fails to make their payments, we refer to that as a default. And the reason why the government can't default really is because they can't go out of business. A corporation can go out of business. The government can't. And if they need money, they can raise taxes. So if you buy a U.S. Treasury security, you're going to get the money you've been promised. And there's favorable tax treatments as well. City, state, and local governments cannot tax the interest on U.S. Treasuries. Now, here's an interesting twist. All Treasury securities fall into one of three categories. Their names depend on the maturity date. So we have what are called Treasury bills, which last anywhere from 3 years to 3 months to a year. We have Treasury notes that last anywhere from 2 to 10 years. And finally, we have Treasury bonds that last anywhere between 20 and 30 years. Now, in the media, though, they often refer to these as bonds. You know, if they're discussing this in an article, they may refer to them as bonds, but the names are actually what you're seeing here. Okay, and I think I've already shown you that website where you can look up the yields on these bonds. Let's go over there real fast. It's called treasury.gov, and then you can put daily yields or daily yield curve, and they'll show you what's going on in the Treasury market today. So for example, right now, this is what you can earn by buying Treasuries. Now down here with the short maturities, the interest rates are pretty pathetic. Up to 5 years, you're getting less than 1% a year. Then you flip over into the 1% territory. And in fact, the 30-year bond will give us 2.35%, which is not awful for this point in time. But by historical standards, these rates are really, really low. In fact, if you were to take a look at, just by as a point of comparison, let's say 2007, oh, you'll notice the difference. Let's take a look at them. Oh, is somebody not muted? I'll take care of that. Okay, we're all set. Yeah, look at the numbers. Oh my God, look at this. Look how high those numbers are. You could 30-year, you could get 4.79%, even down here at the short end here. 1 month's Treasury bills were paying 4.79%. This, by the way, is much more normal for our historical experience. In other words, what we're seeing now is not normal by historical standards. What you're seeing here, this is much closer to what you expect to see throughout US history. The unusual thing about this period in time, though, is that if you notice, there's very little difference from the short end of this curve to the high end. And when I say curve, by the way, if you were to take these numbers and plot them on a graph, in normal times, when you plot those returns to treasuries, which are called yields, you end up typically with something like this. Usually they're increasing, but at a progressively decreasing rate. This is the normal experience. This curve is called the yield curve. And so that's more normal. Now, the case we're looking at here in 2007, if you notice, this yield curve is almost flat. And it happens sometimes. It's just not common. Let's say it looks sort of, yeah, it's almost a perfectly flat line. That's extremely unusual. And there have been other cases, which maybe I can find one of them, where let's say things are really going badly, where the curve actually might be downward sloping. No, not so much here, but look how high those numbers are. This is in the early 90s when the economy was really very sluggish. And look how high those numbers are. The NAs mean that security wasn't being traded at that point in history. But yeah, these are very high rates. Let's try 2001. Yeah, no, they're kind of flat. But anyway, all right, so, but then this is what you would right here is what's more normal in US history. In fact, this is what we're seeing now. It's just that the rates are so unusually low. Maybe you didn't notice it, but Oh, I wanted the whole current month. Let's just look at that. If you look at it very carefully, you'll see that the rates of the low, this is, by the way, I keep saying this without explaining it. This is the so-called short end of the curve, meaning the low maturities, and this is the long end. This is like the 30-year territory. Down here, we're looking at, let's say, 1 month. So this is called the short end of the curve, and this is the long end. You'll see that at the short end, the rates are quite low compared to the long end. So the shape is normal for our history, but the levels are very different. In other words, they're very, very low by historical standards. In fact, there were a couple of times when these yields were getting very, very close to being negative. It has actually happened very briefly in US history. In fact, let's take a look and see if we can find examples of that. When have US yields, treasury yields, been negative? It's a very rare occurrence, but occasionally, there it is, March of 2020. The 1 and 3 month treasury bill yields turned negative on Wednesday. There was only one other period, briefly in 2015 when that happened. Wow. So it can happen. That was March of 2020. Ooh, maybe we should go take a look.
Was it the stock market crashing?
I wouldn't be surprised. That often, although this is when the COVID was first starting, people were becoming conscious. This is when we started having lockdowns. And remember, it was almost exactly a year ago when all of a sudden the schools announced, don't come back. I think it may be more the COVID, although I don't see any negatives. These are closing values. Maybe during the day, the trading day, the yields were briefly negative and then they came back to being positive. But there were brief periods of time when these rates did become negative. Which, by the way, if you really want to study more about the markets, this is a great website for that, where it will show you all these great pieces of information that you might need to analyze what's going on in the markets. Like, this is looking like pretty good news to me. The rally accelerates with the Dow Jones climbing 400 points to an all-time high. The S&P 500 is jumping 1.5%. So the green means those indexes are doing well. There's our friend, the NASDAQ, where the Apple trades. Here's the Dow Jones Industrial Average, which is the oldest stock market index in the United States. This has the so-called blue chip stocks, the big names, and S&P 500 is a broad-based selection of the 500 largest stocks in the United States. They're all having a big day. We don't necessarily know why. Oh, I wonder what's happening with Bitcoin. That Bitcoin, I'm telling you. Let's go back to finance.yahoo and see what's going on with Bitcoin. Which I have no understanding of whatsoever, but okay, it's up to around 60,000. Woohoo, look at that. Yeah, look at that. If you bought Bitcoin last year at this time, you could have had one for just about $7,000, and now it's worth almost $60,000. Wow. Jeez, that's pretty interesting. But you know what? The great famous investor Warren Buffett said, "I refuse to buy anything that I don't understand." And I think that's good advice. Wow. Anyway, so as you can see, this is a pretty exciting part of economics, which is often referred to as financial economics. And here's something I'm not sure if we got to this point yet. Corporate bonds, as you know, are issued by corporations to raise funds, but they have to pay more interest than treasuries because of this default risk, the possibility that the corporation will go bankrupt and not be able to make the interest payments that it promised. So how do you know which bonds to avoid, which ones to buy? that's when we look at these ratings by Standard & Poor's and Moody's. So let me just show you what the Standard & Poor's ratings look like. They're letters, okay? They start at AAA, and then they work their way down the scale. You notice how we have pluses and minuses. And when we get down below A, it becomes triple B plus, triple B minus. Then up here, we move down to double B plus, double B minus. And the reason why the chart is organized this way is because these are considered to be investment grade bonds. These are referred to as speculative, meaning that they're very risky. And in fact, sometimes they're called junk bonds, which is not nice, but that's what they're called. So if we go back to Apple real fast, you notice their rating from S&P is AA plus. AA plus, which puts them at the second highest rating that they have. I'm not quite sure why they're not AAA, but they're awfully, awfully close. And so it turns out that the coupons offered by bonds depend on these credit ratings. And so specifically, I'll just make a note down here, the riskier, the lower the credit rating of a bond, the riskier it is considered to be, and the higher will be the coupon rate that it offers, because otherwise investors won't buy it. So if you want to get a very high coupon rate, you really have to take on a lot of risk. That's the bottom line. But that's true of all financial assets. More risk means higher potential return. All right, so keep that in mind. If you want to play it safe and keep your money in treasury bills, well, you'll be safe, but you won't earn a whole lot of interest, will you? No. So you may decide to have at least some of your money in something riskier like stocks and bonds. All right, anyway, so these last two we can go through these pretty quickly. Municipal bonds are issued by state or local governments or city governments. They have little or no default risk, but none, like treasuries. So, for example, the city of Detroit defaulted on its municipal bonds about 5 years ago, which means that if you own one of those bonds, you're probably not going to get what you thought you were getting. And these also are attracted to very high net worth individuals because they have extremely favorable tax treatment. In fact, if you live, for example, and work in New York City, then a municipal bond issued by the city of New York is not taxable at the city, state, or federal level. You're essentially getting a tax-free rate of return. So they're attractive, but not so much to people in lower income brackets, but to wealthier people. And then finally, we have foreign bonds, which are issued either by foreign governments or foreign corporations. They may then be issued in dollars or in the foreign currency. So there's not that much interest in the foreign currency bonds, but yeah, foreign dollar bonds, we see them fairly regularly. Like, in fact, let's go back to FINRA for a second so you see what I mean. Oh, I like this. Green all across the board. I like that. Man, but I don't know what's causing it though. Okay, so let's try. Let's see, what should we look for? Oh, I know. Let's see if we can find the name of a foreign corporation. Let's try, I don't know, Toyota. Oh no, what happened? Oh my God. How about Nissan? Oh no, you know why? Because this was still here. No wonder it was confused. There we go. Now here's the thing with these bonds. Let's go take a quick look at it. This is Toyota. I believe these were issued in, I can't find, everything's listed in dollars. Most likely these were issued in dollars rather than yen, because otherwise, as an American, you'd be subjected to foreign exchange risk if you buy the yen version, although it could be done. But it appears that they've been able to issue this in dollars. In fact, if you look at foreign stocks, let's go back to finance.yahoo for a minute. Let's try Toyota again. Well, that's CNBC, sorry. TM, Toyota Motor Corporation. It says right here, oh, there it is. NASDAQ real-time prices, currency in dollars. So this stock is actually a special type of stock. It's called an American Depository Receipt, ADR, which means that it is Toyota stock, but it is denominated in dollars. So when American investors buy Toyota stock, they're getting shares that are priced in dollars. In Japan, they would be priced in yen. So as an American, you can buy Toyota without having to worry about exchange rates. All right. So, man, we're having a lot of fun with this stuff. Anyway, so the stock markets, as you know, stocks are issued by all corporations to raise funds, and the purpose of buying stocks is to make a capital gain if possible. And it turns out that if you were to look at all the different assets you could buy in the economy, let me just see if I can find a chart about this. Okay. Yeah, that's all nice, but I wanted a graph. Oh, I forgot to ask for the graph. Okay. Ah, here we go. I'm hoping that they have a little graph for me. Okay, well, it's not exactly what I was hoping for. All right, this will have to do for now. This greenish line is the S&P 500, and this orange line is BBB corporate bonds. So you can see that in general, stocks outperform bonds, but there's a lot more risk. Okay, well, anyway, so, but that's the whole point of buying stocks, that over the long run, you should expect to see a higher return from stocks than from any other financial asset in the economy. Now, by the way, here's an interesting, I threw this in here just for the fun of it. This is a picture of the New York Stock Exchange at Christmas time. You're not allowed to go inside the building anymore, but if you're on the outside, you can certainly walk around, and there it is. Now look at how beautiful is that. You can see it looks like a Greek temple, doesn't it? Up here, there's a very nice frieze. It's pictures of different types of commerce taking place. And at night, they light it up. And at Christmas time, it's all nice and red and green. It looks gorgeous. But the reason why I included this particular picture is because I took it. This is one of my pictures, and I'm proud of it. So therefore, I'm going to leave it in here. And so you can hopefully enjoy it. Oh, what's going on here? Yes, this was taken by my camera. And so, but you can see the building looks really, really impressive. It's meant to look impressive, but it was built at a time when many buildings in Manhattan were using this Greek Gothic style that, you don't see so much anymore. Thanks. I thought it turned out well. I wanted to show it off. What a perfect excuse this chapter turned out to be. All right. So I think we've gotten enough ground covered here. I want to show you this video before we run out of time. It's kind of long, but it covers a lot of ground. And I think you'll find it to be very, very useful in helping us understand what's going on in this chapter. Okay, so let me get that off to you. We got about enough time. It's about 20 plus minutes long, but it'll be worth every minute of it. All right, so let me send you that link and then we'll take a look at it. All right, let's go. All right, let's check this out.
Hey everyone, I'm Mr. Willis, and you are looking at Numbers.
All right. So are we done? All right. Well, I know that was very long. I get it. Yeah. But we're going to spend a lot more time going over what he was talking about. This loanable funds framework will actually be the represent most of the second half of this chapter, where we're trying to develop a framework that helps us understand ultimately where interest rates come from in the first place. Up to this point, we've been basically taking them as given, or without really asking where do they come from. And so that's what that loanable funds market is meant to do. And he also mentioned the Federal Reserve System. We'll be spending a lot of time analyzing the Federal Reserve System in future chapters. That's, of course, the central bank of the United States, and they're the ones who ultimately determine the level of interest rates in the economy. So we have one entire chapter which is entirely dedicated to the Fed and how it carries out monetary policy. So that's coming up down the road. But right now, let's just quickly run through a few more details here before we wrap it up for the day. So we did mention, and we've already talked about this today, besides the New York Stock Exchange, we have NASDAQ, we have the London Stock Exchange, we have the Toronto Stock Exchange. Every country in the world basically has a major stock exchange. And so a lot of these different stocks trade on different exchanges. As we saw, Apple and Amazon both trade on the NASDAQ. But if you look at the stocks that are traded on the New York Stock Exchange, these would be most of the best known corporations in America. Let's see, let's get a quick list going here. Stocks that trade on the New York Stock Exchange would include, a lot of the most important ones that you know very well. For example, well, there's a lot of small ones too. Well, yeah, it should, but it depends. If just in general people save more, that should increase the supply of loanable funds, unless there's something else that's offsetting it. Or if, for example, if people are saving more or a larger percentage of their incomes because the economy is slowing down, it's still possible for the total to go down. But just in general, more savings tends to lead to more loanable funds. That's right. But all right, anyway, so let's see who's on this list. Apple. Now, Apple, according to this, is trading on both exchanges. That does happen sometimes. But these are the companies that are probably the best known. And compared to, let's say, the NASDAQ, where they primarily focus on the high-tech companies. But, and of course, we saw in the NASDAQ, they tend to have the high-tech. And then every other country has their own, like, say, the London Stock Exchange is where most of the largest British corporations trade. Toronto, the same thing for Canadian stocks. And then we have the so-called over-the-counter market. This is where stocks trade for companies that are really too small to be listed on an organized exchange. So here's where you have trading directly between buyers and what are called market makers, who themselves hold an inventory of stocks, which they will buy and sell with anybody who wants to. And where do they make their money? They use what's called a bid-ask spread. So let's say there's a market maker out there who's carrying Apple stock, and they'll offer to sell it to you for $122, but they'll also offer to buy it from you for $120. So they're basically trying to make $2 on every trade that they make. And so the difference between those two prices, which is known as the bid-ask spread, is equal to $2. Okay, so that's where these market makers make their money. This is what you are dealing with the over-the-counter market. So normally Apple wouldn't be traded through the over-the-counter market. They would be traded on the NASDAQ, but any stock in principle could be traded in the over-the-counter market. As long as there's somebody who's willing to buy and somebody who's willing to sell, then that's all we need. So we have the electronic networks, and these, you're probably not as familiar with them as some of the others, but they do exist. These are designed for electronic trading. Some are meant for large retail investors. Some of them are meant for individuals. where you can just go in and directly place orders without dealing with actual individuals involved. Now, one last thing I wanted to look at is if you look in the newspaper for a quote for a stock, this type of information is typically attached to it. And most of it is pretty straightforward. For example, 52-week high and low, that tells you the lowest price that your stock has traded for in the last year. High obviously means the highest price. This is the dividend that it pays, $1 per share. The yield is the dividend yield, which means if the price is roughly $50 right now, you can tell because $1 divided by 50 would give us a yield of 2%. Let me skip over PE for a second. The volume in hundreds, this means that this many shares of the stock traded that day. And the closing, oh yeah, there it is, $50. Yes, it has to be $50. That's the price at which it traded when the exchange closed at the end of the day. And that's why the yield is exactly 2% here. And this 0.27 tells me that the price went up 27 cents from the day before. PE stands for price earnings ratio, which means it's the ratio of the price over what we call earnings per share, which means how much revenue did the company earn from divided by each share of stock. All right, so let's take a look at a quick example of this. A corporation has earnings of $1 million and they have 10,000 outstanding shares of stock. Earnings per share would therefore be $100, okay, because they have $1 million worth of earnings or profits. They have 10,000 shares of stock. That means the average per share is $100. If it turns out then that the price of the stock is $400 a share, that means the PE ratio is 4 because you're basically paying $400 to buy a stock whose earnings per share is $100 per year. So the PE ratio is listed as 4. Now, is that a high or small number? That depends on a lot of other factors. The one we saw here was 14. Okay, so 14 is probably a much more normal value. In fact, we could go back to finance.yahoo.com for a second and take a look at some PE ratios. For example, let's try General Motors. And we'll see the price earnings ratio is about 14, okay? How about, now Apple's is going to be very, very high. That's why I didn't want to look at it first. Apple's PE ratio is going to be pretty high, I'm betting. Yeah, 34. But that's what that usually signals is that the market expects their profits to go up in the future. Often a high PE ratio means the stock is very expensive compared to its earnings, but it also means investors are willing to pay that price because they really believe that the price will go up higher in the future. So that's something to keep your eye on. These PE ratios can be a sign that the market believes that the price of the stock will go even higher in the future. And let's just look at one more out of curiosity, Amazon, which is at, yeah, look at that, 77.13. Okay, that's an enormous number. But again, people are willing to pay that because they really believe the price is likely to go up in the future. So that's a good sign for a stock like this. All right, well, anyway, I think, oh, it's 2 o'clock. I guess we better stop right here. And we'll pick it up from here. Now, next time we'll be looking at the actual loanable funds market with the supply and demand curves. We're going to see where they come from and what happens when we shift the curves around. And when that's done, we'll be ready to look at the next chapter, which is our look at money, one of the most exciting topics in the world, money. And that will be closely followed by the Federal Reserve System and how it regulates the money supply and interest rates in the United States. All right, so I guess if there's no last minute questions, we'll stop right here and I'll see you all on Thursday.
Thank you.
Okay, you're welcome. No,
Thanks.
the midterms aren't done yet. They're probably
Thank
taking-
you.
See you later.
Thank you.
Okay, you're welcome. Bye.